This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV. It's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
Support comes from ServiceNow. We're for people doing the creative work they actually want to do. That's why this ad was written and read by a real person, and not AI. You know what people don't want to do? Boring, busy work. Now with AI agents built into the ServiceNow platform, you can automate millions of repetitive tasks in every corner of your business, IT, HR, and more, so your people can focus on the work that they want to do. That's putting AI agents to work for people. It's your turn. Visit servicenow.com.
Welcome back to The Bull, your personal finance podcast. We've mentioned his name many times. Over time, it has become familiar within our community. Every time the question arises, could passive investing cause long-term damage to the market? His name inevitably comes up. He is widely recognized as the leading voice on the global financial stage among those who believe that passive investing can create irreversible distortions. We are talking about a legendary investor, the man who in 2018 saw the Volmageddon bubble coming before anyone else. In just one day, his fund made tens, perhaps even $100 million by betting against the bubble. Over the years, Mike Green has increasingly focused on the impact of passive investing. And by passive, he doesn't just mean investing in ETFs, but rather any strategy that follows a market cap-weighted approach, allocating capital based on market capitalization. Are we, like the proverbial frog in boiling water, unknowingly being cooked as the market inflates the biggest bubble of all time? As you know, many disagree with Green, and for what it's worth, I'm among them. But I believe that developing a well-rounded, independent perspective requires understanding all sides of the argument. But let's not waste any more time. Mike had a lot to say about it. So, without further ado, here's my conversation with Michael Green. Enjoy! Dear Michael, welcome to my podcast, The Bull.
Thank you, Ricardo. It's a pleasure to be here.
It's great to have you here. You are very well known among my audience, and today you will be the bad guy because we're going to talk a lot about passive investing, but I feel you have a couple of things to say about it because, as the Led Zeppelin used to say, not all the glitters are gold or something like that. I don't remember the exact quote.
All that glitters is not gold, but or nothing gold can stay, or any variant of those. Yeah, no. Listen, it makes me very happy that I get to be the bad guy. I'm the father of 3 children, and I used to say this all the time. I knew I was being the best father when they said, "I hate you," because I was making a hard choice and making an observation or imposing something on them that they ultimately knew was right, but didn't want to make that choice themselves. And unfortunately, passive investing falls into the same category. If you hate me, it's because I'm telling you something that's true that ultimately you don't want to hear.
Yeah. I always advise people that once you hear Michael Green, especially talking about this topic we're going to be addressing today, that will likely change their mind about it, at least a little. So, let's start with a memoir of 2018, because I think it's relevant to come back to one amongst your greatest achievements of the markets, that, in my opinion, has something to do with the way you started thinking about the passive investing stuff. You had a great career, you work with Peter Thiel, the tech billionaire that partnered with Elon Musk at PayPal, with George Soros, a legend to say the least. And in 2018, I suppose you became very, very famous on Wall Street for the Volmageddon story. Would you tell us what happened back then and how did you spot that inefficiency in the market?
Sure. So Volmageddon refers to the implosion of the XIV and SVXY ETFs on February 5th, 2018. These were very popular products. XIV was about $2.5 billion in market capitalization at that point and had spurred all sorts of commentary around its extraordinary performance. It was up 600-700%, I think, in 2017. That fund imploded in a single day, moving from basically all-time highs to closing on a single day, February 5th, 2018. And I was fortunate to have predicted that this would happen in advance and to have positioned my employer at the time, Peter Thiel, to benefit from it. The observation was actually very similar and underpins... Ricardo, you've frozen? Okay. And underpins a lot of the work that we'll discuss in terms of passive investing, in that I had recognized that effectively the market itself had become a positive feedback loop where the supply of this product was actually being used to compress equity volatility. This product benefited from compressed equity volatility in terms of the shape of the vol surface, and that in turn drove additional inflows, which compressed volatility further. It's very similar to rising valuations in the passive framework. The compression of volatility can be thought of almost as a valuation metric for volatility funds. And what I had recognized was that the impact of systematic algorithmic trading, which is really what passive is, and we'll dig into that in a second, had become so large in this market that it had overwhelmed the traditional players in the space. And so about 70% of the trading volume on any given day was being taken up by the systematic rebalancing of the XIV and SVXY and related ETFs. My work around passive, again, we'll dig more into that, was the importance of these types of feedback loops in creating market behavior. And what I recognized was that the effective leverage, the beta of these strategies had climbed from about 4 times the S&P to about 22 times the S&P by the time the events of Volmageddon occurred. That had actually been in place for several months. That allowed me to figure out effectively what would happen if we saw a significant correction in the S&P 500 of about 4%. It meant that this product would likely go to zero. The underlying structure of the product, and this is true for any inverse product, if you are 2x or if you're 1x levered to the return of the S&P, and the S&P goes up 100%, your fund goes up 100%. If you're negative 1 times levered to the S&P 500 and the S&P doubles, even though the S&P has not gone down or gone to infinity, your inverse product will have gone to zero, right? So plus 100% gain means by definition minus 100% is going to go to zero, your fund is gone. That asymmetry was not being properly priced into the options market. And so what was truly a bimodal distribution, meaning that the odds of it going to zero were rising and distinct from the underlying distribution of options, was not properly priced in. And I was able to take advantage of that to build a fairly sizable position and recognize that this was effectively a model of what could happen in many other markets. When there was a moderate regulatory change on February 2nd, 2018, in which the Federal Reserve changed the treatment of volatility positions on what's called the capital adequacy ratios, that set off a demand to buy back short volatility exposure that culminated in the implosion of this product on February 5th, 2018. That's what Volmageddon was.
And you made a fair amount of money with that bet.
Yeah, no, we did well in the trade. Yeah.
Besides the technicalities, if I get it right, your idea back then was that too many people were doing the same thing at the same time without really figuring out what was going on. And these things typically end up badly.
Too many people doing the right thing right? Without thinking about it can be almost as bad as too many people doing the wrong thing without thinking about it.
Sure.
Right? If everybody decides to turn right at an intersection because that's the law, does that intersection function properly? Well, if traffic is normal, sure. But if the intersection becomes very crowded, that legal and proper behavior can create extraordinary challenges. And this is the same underlying phenomenon. Too many people trying to do the same thing at the same time, run from a theater on fire, creates the crowded exit dynamics, and things don't work the way that their founders intend.
So, the million-dollar question is, what's wrong with passive investing?
Well, it's a variant of the same underlying phenomenon, but unfortunately in this case, it's actually layered on top of multiple misunderstandings in the market. The most important one being the pure definition of passive itself. So the academic or theoretical definition of passive investing that actually underpins the regulatory framework for how many of these products are treated is that a passive investor always holds every security in the market. That's a really important distinction because holding is a passive activity. But it then raises the question of how do you get into the market or how do you get out of the market? And by definition, that those activities cannot be passive. And this flows through the underlying literature. The actual academic literature treats that question as saying, well, they magically transact in periods in which the markets are not open. So we're not going to pay any attention to that. And that was really kind of my key contribution to the space, was to say, hey, wait a second, that's an unrealistic observation, because every single day, Vanguard, BlackRock, and other passive flow complexes are receiving inflows. And so what we properly have to define them as is not passive investors, but simply algorithmic investors that are using a very simple framework. I'm going to buy every security that is in my universe, and I'm going to do so in proportion to their market capitalizations. Once you recognize that that is the underpinnings of the strategy, then you can actually start to look for the implications of it getting larger and larger and larger in terms of the share of the activity. And that's what my work is focused on, is identifying how we would expect that to impact markets, as well as what are the logical or simulation-based outcomes from this type of behavior.
There's a lot of implication starting from that. I suppose one of these implications is that you feel the market has become somewhat less efficient due to the growth of passive investing. Accordingly, the market is not doing what it is supposed to be doing, efficiently allocate capital, because something is distorting this self-regulatory mechanism that should underpin the markets. Is this one of the problems?
Well, again, this is one of these interesting phenomena where how you define efficiency is going to determine the implications. So one of the components of thinking about how efficient a market is to make sure you understand what academics mean when they say efficiency. You provided me with a brief outline. You highlighted that Eugene Fama has articulated that he sees no evidence that markets are becoming more inefficient over time with the growth of passive. One, I would just say that, in part, he's an interested party to the discussion. As the progenitor of the efficient market hypothesis, he'd very much like to believe that continues to be true. The second, though, is actually the definition of efficiency. So you and I might define efficiency in a quote-unquote real-world term and say, how far do prices deviate from quote-unquote fair value? That, unfortunately, requires us to be the theoretician who says, here's fair value. Fair value, unfortunately, is not a knowable concept. I have a forecast for cash flows and an estimate of a weighted average cost of capital and risks associated with a company that could be radically different than yours. The transactions between us is ultimately what determines the price. You may think it's undervalued. I may think it's overvalued. If I have some in my portfolio, I might sell you some of my shares, preventing the price from rising as much as you might think it should. At the same time, if I don't have any shares and you've bid up the price to a point that I think it's irrational, I can synthetically create shares by shorting the stock. I can borrow them and sell them. That's how markets are supposed to work. It's an interaction between informed or less informed parties, basically trying to assert a fair value view on the market, and the wisdom of crowds ultimately plays out to give you something that is reasonably close. The problem is that's not the academic definition of efficiency. The academic definition of efficiency is how quickly do prices change in a manner to reflect the information that becomes available. And so paradoxically, a market that does not move at all, except when an earnings report comes, and then the earnings report causes high degree of volatility, and then the volatility stops afterwards, is actually viewed as a perfectly efficient market. New information showed up, prices changed to reflect it, and then they didn't change at all to reflect any other information. Ironically, that's a most efficient market. Now, you and I would look at that and say, well, that's absurd, because then I have an incentive to go out and gather information so that I can make a prediction as to where the price will go when that earnings is released. I will then try to buy in advance of the earnings, anticipating a positive earnings surprise, driving prices higher. And therefore, the price doesn't end up moving at all on the earnings response if I've actually gotten control of all the shares. I've profited by raising the price prior to the earnings report. Which market feels more efficient, right? You and I, again, would say the second one, because prices actually did reflect the underlying information. But paradoxically, an academic definition would say the market, the prior one, where there's wild swings around the earnings report, is much more efficient. It depends on how you define it, right? I would say that the market that moves wildly on the earnings release and then stops moving in any idiosyncratic way is actually terribly inefficient, but completely consistent with my models of passive.
The answer from Eugene Fama was prices are basically right, or you should be acting as if they were perfectly right. As far as you know, this is the basic assumption when investing. He says he didn't see evidence about these changes, but we know that he may have some conflict of interest in saying this.
Well,
what do you think?
So let's take a different approach, which is to actually go to the evidence that Fama is saying he sees no evidence of. And hopefully, when your audience sees this, they'll recognize that as I call my presentation and forthcoming book the greatest story ever sold, Fama is just lying to you. And it's disappointing that he's doing so, but he is, if he says that there's no evidence for it. Because here's what's actually happening. All right, so just very quickly, what we have actually seen is that earnings day moves are now, give or take, 5.5 times more volatile than non-earnings days. That didn't used to be the case. If I go back into the mid-1990s, when about 80% of transactions were actually driven by active managers who were trying to engage in this thoughtful process of figuring stuff out in advance, you had roughly 1.5 to 2 times the daily volatility on earnings, because prices had already reflected the anticipated information. Today, those earnings reports are about 5.5 times more volatile than the remaining days. And again, you could define that in the academic sense that that's very efficient, right? New information, quote unquote, new information comes out. But what it's actually telling you is the effort to obtain information in advance has collapsed. And that is paradoxically directly against the models of reinforcing market efficiency that are promulgated by what's called the Grossman-Stiglitz framework, which is this idea that, the opportunities increase the more passive a market gets. Under a Grossman-Stiglitz framework, that greater volatility would create greater incentive for the production of quote unquote information. That production has actually fallen markedly. The work of Davidson Heath at the University of Utah's Eccles School of Business shows that as passive share grows, the production of earnings reports and analysis and reading and attendance on earnings calls, etc., falls in a very predictable and understandable way. People have effectively given up trying to understand in a lot of ways. And what they're largely trading today is price, which is a component of that market capitalization weighted in the passive indexing approach. So whether they realize it or not, they're increasingly trading off of the signals from passive.
But around this topic, There's a huge debate about the point of no return, the threshold, when passive becomes too much passive. And it is difficult to really know how passive the market has become, because if we just count the asset under management by index funds and market cap weighted ETFs, it could be something between 10 to 20%. But there are papers that explain that the real passive share of the market is more likely 50-60% because of closed index funds, direct indexing, and other ways to invest through algorithmic trading, for example. Is there a threshold, in your opinion, beyond which the market starts to fall apart?
Well, again, fall apart is an interesting description. Trying to think about the right way to say this. The process of shifting towards passive is a process that is cumulative in its nature. Again, the really key component is to understand that passive investing means that you are engaged in a systematic algorithm in which you allocate new funds in proportion to the existing market capitalization of all publicly traded companies.
Sure.
And so the share of those types of strategies that reference indices has risen on most metrics, including mine, to around 45% of total market capitalization of quote unquote managed assets. In other words, money that is in funds of one form or another. And I would include in that mutual funds, ETFs, hedge funds, etc. That number seems to be somewhere in the neighborhood of about 60 to 65% is now passively managed. And ultimately, what that means is that there are fewer and fewer investors with large pools of capital that are trying to define the quote-unquote right price. Everyone's basically assuming everyone else has done the work at this point.
Good point. If you don't mind, I have collected some amongst the typical counter-arguments against those who claim passive investing is doing something bad to the market. And I'd like you to address these topics. The typical one is index funds and ETFs are price takers, not price makers. They just hold securities at whatever price active investors set. Therefore, they don't have a meaningful impact on prices.
But one, that's just an absurd assertion, right? This idea that you are a price taker as compared to a price maker. Anytime you transact, you are by definition a price maker. You have actually chosen to transact at the price that is available to you. It's very similar to walking into a grocery store and accepting that the price of pasta is, 1.5 euros. If you were to look at the price of pasta at 1.5 euros and say, there's no way I'm going to touch that pasta, 1.5 euros is completely absurd, and you walk away from the store as a quote unquote price taker, what you're ultimately doing is leading to oversupply of pasta, and therefore the prices will fall. That ability to abstain from transactions is called elasticity. How elastic is my consumption function in response to price changes? The real definition of passive investing is that they are perfectly inelastic. Oh, the price is $1.50 for pasta, or euro 1.50 for pasta. I'll take it. Price is 2 euros. I'll take it. 4 euros. I'll take it. Oh, and by the way, if it happens to be part of an official basket, right? So you walk into the grocery store and it says, here's the official basket dictated by the Italian government. If it happens to be in this basket, every time I walk into the store, I have to buy everything in that basket, right? What is that going to do? That means that if a price good in that basket raises its price relative to everything else, I'm going to now be allocating more of my purchasing power to that higher priced item because I have no choice. I have zero elasticity. I'm perfectly inelastic. And that's really what we're seeing in indexes.
Before I move to the next counter-argument, how can we prove the direct link between the growth of passive investing and the prices becoming less elastic?
Well, this is one of the key challenges, right? So we actually have significant evidence for it, and we have techniques called instrumented variables in which you are examining a high number of transactions to see what unique characteristics causes particular changes in prices. When you use those complex techniques, it becomes very clear that inclusion in an index and flows of money into that index reflect this low level of elasticity that I was referring to. And that low level of elasticity, again, unfortunately, your audience can't see the picture, but as stocks get bigger and bigger and bigger relative to other stocks, they become increasingly inelastic in an index framework because I can't exclude them from the basket. Similar to that posted basket walking into an Italian grocery store that says, you must buy these 5 items every time you walk in. Those 5 items are going to be perfectly price inelastic. Everything else in the basket, you may have wanted to buy some limoncello when you went into the store, but if you spend all your money on those 5 items that are in the official and required basket, you have no money left over for limoncello, right? That means that limoncello becomes highly price elastic. This is the same phenomenon that we see in markets, where the smaller the market capitalization, the more discretionary the fraction of purchasers are going to end up being, and the more elastic that stock is. The larger the company, the less elastic it becomes. As a result, prices actually rise more for those companies in a very counterintuitive fashion. Or more accurately, not prices, market capitalizations rise more for those companies than for other companies.
Okay. Another argument along this line is, at least if you have studied in Chicago, I suppose, because it's typical Chicago-based argument.
You had your first mistake right there, but okay, let's go ahead.
Okay. So the argument is, it doesn't matter the passive share of the market. It matters how many actors, investors keep doing the homework of setting the prices. Paradoxically, a bunch of very well-informed active investors set the prices, and 99% could be passive without the market becoming less efficient. I read something about it from Owen Lohman, for example, and the same Eugene Fama.
So this is the Grossman-Stiglitz framework, and effectively the Grossman-Stiglitz framework restated says that the more passive or less informed investors there are, the greater the incentive is for information production and generation by a group of informed traders. The returns are expected to scale with that opportunity set. The problem is that just doesn't actually match what we empirically see, in part because the improper academic definition of what a passive investor is somebody who never actually transacts. The minute you recognize that the passive investor does transact, that they buy when you enter the market and they sell when they exit the market, then that methodology starts to change. And what you need to consider is what's called the strategic response of other investors. How much more active do they become in order to offset this algorithmic activity that's happening from these quote unquote passive investors, right? And I emphasize that quote because they are not passive, they are transacting. So what you really need to describe is not just the number of investors, which again is a mistake from labeling passive investors who can't be passive according to the definition of passive. There was no way for them to get into the market, and there's no mechanism for them to get out of the market. So calling them passive and the entire thought experiment is stupid. And disingenuous, to use a more complicated word that might be more politically appropriate. The question that you have to ask is, how much more aggressive do the other investors become in response to this new class of systematic algorithmic investors? That falls under the work of an academic called Valentin Haddad at UCLA. He's French by origin, so the Italians will hate him. But his work is actually specifically on this component, and what he identifies as what's called a partial competitive response. In response to other investors shifting to this mode of investing, some investors become informed and recognize this condition and start to change their behavior by becoming more aggressive. But most investors do not change their behavior. And those investors who do change their behavior don't change by enough to offset the impact of the passive investment. And specifically, he finds that the partial competitive response offsets about 2/3 of the impact of the passive investors. And as that accumulates over time, as there are more and more passive investors, basically those who respond to them actually perversely can no longer change markets, and therefore they start to defect. They effectively become a fifth column in war terms. They switch over to the enemy's camp and decide to make profits by engaging in patterns of behavior that amplify passive activity. That's really what we're seeing more and more of, is basically value investors throwing in the towel and saying, what I used to do no longer works. I'm just going to embrace stupid. And that's unfortunately what we're seeing now in markets, where more and more money is invested in ways that reinforce momentum, the underlying characteristic of this type of investing.
Well, what is the bad outcome that eventually will play out?
Well, it is the crowded theater phenomenon, where there's a fire and everybody needs to use the exit at the same time. People don't realize how crowded the theater has become, in part because it's more like a teenage dance club than anything else, right? As adults, we tend to invest and we think, a crowded theater, we'd immediately become aware of it and choose not to attend because the volume would be too loud and the seats would be too crowded and the performance wouldn't be visible, and all these sound really unenjoyable, right? But the reality is, as the theater becomes crowded or the dance club becomes crowded, your prospects of meeting a girl rise. The environment is more exciting and chaotic and feels more fun. Prices rise, and that's an indication that things are really robust. But the system is very prone to collapse. If people try to leave, they suddenly discover that the exits cannot accommodate the flow.
So there might be an exogenous event that triggers a lot of people to freak out, and there won't be enough liquidity to make the market work properly. Is that right?
Yeah, I mean, that's the actual mechanical implementation of it. But the easiest way to think about it is the difference, the easiest way to think about it is this crowded nightclub phenomenon, right? The exit can only accommodate so many people trying to leave at the same time. And the exit isn't necessarily upgraded as you offer better nightclub acts and better DJs and, more higher quality drinks and specially crafted cocktails, etc. All things designed to draw people in. The exit gets no real consideration in that process. And my work around this type of behavior is what informed the trading on XIV, where it became very clear that there was nowhere near enough capacity in the exit vehicle or in the exit of that vehicle to accommodate the flows that would be required on a relatively modest change in the S&P.
Let's state a counter-argument, which might be a naive one, but I think it's interesting to get to the point. For example, in 1999, I was 15 years old, so I just read about it, but I knew that a lot of people were piling into tech stocks, and we know it ended up badly when the dot-com bubble burst. At that time, there was no meaningful share of passive investing. There were a lot of mutual funds, people invested in stocks, but index funds and ETFs were a tiny fraction of the market back then. And something like that happened anyway. A lot of people doing the same thing, piling into the Nasdaq 100, into the QQQ just created, and then things fell apart. Now we have a lot of people investing through target date funds, for example, in the US, or anyway, according to some mechanic rules of asset allocations. Here, for example, a lot of people decide to invest with a 60-40 portfolio made by ETFs and specific rebalancing and asset allocations rules. So, in case something like 1999 happens, For example, the target date funds must buy stocks when other people sell stocks to rebalance the portfolio allocations, no matter what. So, in my opinion, there's an automatic incentive to rebalance the portfolio positions and to buy when others are selling. Isn't it something that could offset the problem you are warning us about?
So the quick answer is they are stabilizing features. What you're describing is systematic portfolio allocations that are responding to only the price signals again. A target date fund, just to orient your audience, I'm sure most of them know what it is because they've been listening to you, but a target date fund is a fund that chooses a allocation of assets, typically domestic equities, international equities, domestic bonds, international bonds, in a proportion that reflects your retirement goals or your particular need at some point in time. So the only question that it asks is, how old are you? Or when do you expect to retire effectively? What is your target date in terms of these funds being available for you? And you are correct in saying that if equities fall relative to bonds or domestic equities fall relative to international equities, that then leads to a rebalancing of the underlying assets. But it also presumes that the underlying assets themselves continue to grow. So there are new inflows into the strategy, or at least I'm not taking assets out of the strategy. If the actual source of the volatility is the fund itself, I am selling down shares of my target date fund because I am in retirement. And therefore, I'm actually selling these assets. One, you don't get that same rebalancing feature. And two, the actual inelasticity around that component means that I am even more likely to sell a higher dollar amount as prices fall. So if I'm taking liquidation of my retirement assets and I'm doing so on a consistent basis that pays me a pension of roughly €1,000 a month, if I'm receiving those flows and equities have fallen or bonds have fallen in price, I actually paradoxically have to sell more. So I'm actually selling more into those conditions. I agree, by the way, that target date funds and any form of systematic portfolio allocation by definition is mean reverting. If I decide that my portfolio is going to be 50-50 bonds and equities, and I rebalance to that on a continuous basis, that means that bonds and equities by and large are going to behave almost identically to each other. If bonds go up, then I will need to buy more equities. If bonds go down, then I will need to sell equities, right? And so you end up seeing effectively almost a helix type framework where the products have to react to each other. That, I think, was a critical component of what we saw in 2022 when bond markets sold off aggressively in response to the Federal Reserve hiking interest rates. If you remember, everyone shouted from the rooftops that this was going to be the end of large cap tech growth because now that interest rates were higher, growth stocks would underperform because people had to pull forward the cash flows associated with those discounted cash flow models, and therefore value would be more attractive. Did that play out? Not at all, because it had nothing to do with it. Nowhere in the calculation was anyone actually doing a discounted cash flow. They were just rebalancing their portfolios. And so target date funds are mean enhancing or mean reverting strategies. But whether they increase volatility or decrease volatility depends on the direction of flows. And so far, and this is really the defining characteristic of passive investing, almost every day for the past 30 years, we have seen inflows into these passive strategies. We have very little information on what it looks like when they sell.
Yeah, I got it. Given that this is the environment we are in and no one can individually stop the process going forward, what should the individual investor do?
Well, this is unfortunately kind of the kill shot on the process, right? This is a true tragedy of the commons in which your incentive as an individual investor is to maintain your performance relative to others, or at least not underperform so that you lose relative wealth. Under that framework and the growing passive style, your incentive is actually to join the party. and be part of the party, and in many ways try to amplify the party by taking on slightly increased leverage to the same underlying strategies so that you can outperform as these inflows occur. The problem is, when do you leave the party? And that's the issue that we all face. And so now it's largely determined by demographic features, whether that's a broad recession in which many people lose their jobs and therefore contributions fall relative to withdrawals, or it's a macro or it's a demographic feature. More and more people move into retirement and start taking distributions from these funds. Or the funds themselves, in the case of target date funds, begin to reduce their equity allocations, etc. Ironically, what this means is that stocks and stock markets become increasingly inefficient at a micro level, so they no longer reflect the behavior of the individual stock, and instead they become macro efficient. They reflect the large cyclical components of demographics and business cycles. And unfortunately, that's exactly, again, what the academic studies are showing, that markets are becoming increasingly micro inefficient and increasingly macro, quote unquote, efficient. Just means we can't see the hammer coming until it hits us in the face.
If I can rephrase it, it seems just like the pollution. It's good for the individual, bad for the society as a whole. I shouldn't be driving my car, but I'm better off driving my car and keep polluting the environment. Isn't it something like this?
Yeah, I don't love the analogy, in part because pollution in its broader sense is actually a very clear negative, right? Nobody celebrated their newly increased living standards and the ability to drive a car as compared to a methane emitting horse, just to point out that there's all sorts of environmental conflicts in what you highlighted. But if I'm driving my car, do I want to drive to the coastline of the Mediterranean that is horribly polluted, or do I want to drive to the coastline of the Mediterranean that is pristine? Obviously, I want to drive to the coastline that is pristine, and so pollution is an unmitigated bad in that framework. We all can see it. We all universally accept that a polluted coastline is unattractive and a bad feature. But high stock prices, those are good things. And therefore, we're all very happy to participate in this process, not
As long as they are.
As long as they are. So what I'm telling you is the equivalent of, look, next time you go to the Mediterranean, you're going to discover that it's terrible. And you go to the Mediterranean, you don't see the evidence of that. In fact, it looks better, right? And you go to the Mediterranean, you see the evidence that it looks better. And eventually you just say, yeah, that guy's a crank and has no idea what he's talking about. But the reality is there's just, it's the equivalent of Toxic Bob Friedman, where he stored a giant retaining pool of cyanide from a copper gold mine in, I think it was Venezuela, and that dam breaks all of a sudden and the environment is destroyed in one event. That's unfortunately the outlook.
Should the government, the regulators, the SEC step in to do something?
Yes, but they won't.
Why, in your opinion?
Well, there's a couple of reasons. Again, pollution is easy to see and for everyone to decry. High stock prices could be very good, or they could be a bubble. And our ability to declare that in advance is very much in question. And your listeners, by the way, should be very skeptical of anyone, including myself, who comes on and says, we're in a bubble, because it presumes that I have information that is superior to everyone else's, right? What I'm emphasizing is actually the mechanics of how we've built our market and the mechanics of how we are directing our flows is contributing to this very specific phenomenon with predictable results. It is purely conjecture and hypothesis on my part that the flows would turn negative. I can walk through the thought exercises on why they ultimately will, but that's conjecture at that point. And the implications of it are also conjecture. So you could choose to completely reject my interpretation of events. But the minute you actually accept that passive is impacting the market, and you fail to ask the question, what happens when the flows reverse, simply accepting that they are? What you're ultimately doing is saying, I'm putting my fingers in my ears and pretending that I can't hear anything concerning going on. right? I'm only going to react to what's directly in front of me. And that, unfortunately, is where regulators largely are. We're so terrified of our environment of low growth that any signs of it, rising stock prices, for example, are embraced and encouraged. Anything that could cause them to move in the opposite direction becomes a source of fear and uncertainty. And that, unfortunately, largely describes the regulatory framework that we're in, where we are increasingly saying we have no idea what's going on, but everything seems fine, so let's not try to upset the apple cart.
Do you believe in the widespread idea that BlackRock, Vanguard, State Street are going to rule the world because of their huge voting powers in several companies, because of the share they have in any companies all around the world?
No, I don't think that's the issue. I think the core issue is actually that because they have grown to be such large institutions relative to any other institution in the market. So Vanguard and BlackRock are about $11 trillion in assets, $12 trillion in assets each. The next largest players are kind of at that 1 trillion level. And then there's a host of people that are much, much smaller than that. That type of concentration has really never been seen in the industry before. It means that the benefits associated with size have largely accrued to a minor number of players. Those players are now in a position to influence policy to reinforce their position. And that's really the critical thing. You're starting to see more and more of this in Italy. You and I started this conversation with an offline discussion of Italians are bad investors, right? One, I don't believe in those sort of characteristics. I don't think that the Japanese are particularly frugal, or that the Chinese are particularly industrious, or that the Greeks are particularly lazy. I think that there are cultural feedback components associated with it, but the idea that there are these inherent characteristics that are somehow tied to your ethnicity is to me largely foolish in this context. What I do think exists are restrictions and enforcements around particular phenomena. So Italy has a non-robust fund environment in which high fees are allowed to persist because you do not have authorities who see the benefit of pushing alternative investment vehicles and lowering barriers to entry for competition. So I think that's one of the key things to keep in mind on this. The second component then boils down to if the authorities are unaware of the importance of competition and reinforce the idea of good investing and bad investing, where passive investing or low-cost investing is quote-unquote good, and active investing, or often confused as high-cost investing. Although in the United States, I just want to emphasize that the average active fund is now cheaper than the average passive fund was during the periods of growing popularity in the early 1990s. Vanguard funds used to run 50 to 75 basis points. They now just cut fees from 5 basis points to 4 basis points on most of their funds. 1 basis point has no impact on performance whatsoever. This is just absurd, right? But the move from active managers from 200 basis points and load fees and everything else, distribution fees that used to be loaded on, that have now been taken away, that's an unalloyed good in many ways for investors. But it's one that we've forgotten how important it was in our pursuit of very low-cost investing, which has been blessed as good and reinforced in a legal framework and a regulatory framework in the United States, so that more and more money is invested in these strategies. That's being driven by BlackRock and Vanguard's lobbying. It's being driven by an inappropriate and incorrect interpretation of what passive investing is. And unfortunately, it means that the regulatory authorities are now the primary driver of the growing risks that exist in the market.
I see. Before we close, give us financial advice, just as a joke. Imagine the typical investor in Europe investing X% of her wealth in the MSCI world or in the MSCI all country world, so 60 to 70% in the United States, which means most of the money in the Magnificent Seven and few other companies. Regardless of the reasons why we have arrived at these high prices and high concentration. It's a matter of fact that it never happened, or quite never happened in the past, that so few companies made up for a huge share of the S&P 500. How would you suggest to behave to make sound investment decisions in this situation?
Well, unfortunately, I think the reason that we have that phenomenon is because of the work that I cited, the Valentin Haddad framework, in which the largest companies are the least elastic and therefore the most affected by the flow of funds into passive indices. And so I don't think it's because these are the greatest companies that the world has ever seen, although I think many of them very well may be among the greatest companies. I also think that we tend to ignore the feedback loop associated with that, because companies like NVIDIA and Microsoft and Apple are able to compensate their employees through stock options, warrants on stocks that are going to be released. That is allowing them to offer higher levels of compensation and attract more talented and higher value employees at lower cost than their competitors. And so you're actually creating a weird feedback loop that can make these companies better, quote unquote, than many others appear to be. It also means that they can offer credit to their customers because the value of their equity is so inflated that they're able to point to that and say, we're very good risk. And so they're able to extend favorable credit terms to their customers. Well, that can allow the company to become more profitable. So I just think this idea that we think these are the greatest companies that we've ever seen, and therefore they behave in this fashion, is fundamentally confusing cause and effect. I think the second thing that I would emphasize, and this is really my broad advice to all investors, invest for what you need, not for what your neighbor wants. And it's really easy to get caught up in the idea that somebody got very rich buying NVIDIA, or somebody got very rich buying Bitcoin, or somebody got very rich, right? We all want to emulate the very rich person, but we rarely stop and think, well, what do I actually need from my investments to allow me to achieve my individual objectives? And we're being given a really interesting opportunity in which real interest rates, inflation-adjusted interest rates in both the United States and Europe, are much more attractive than they've been for a long time. I would encourage people to look at whether they can meet their needs, their objectives, with relatively low risk, and to embrace that where possible, while recognizing that this mania of passive investing can go on for much longer than I or anyone else can remain solvent. So be very careful about trying to short this as well.
So if I can wrap up your suggestion, you say don't keep up with the Joneses and invest more in bonds.
I mean, that's the obvious takeaway. I wasn't aware that Jones was an Italian name, but
no, it isn't. But we know the phrase.
Perhaps don't keep up with the Ferraros or something.
Okay.
Right? No, invest for your own objectives, not for the objectives of your neighbor.
Yeah, it really makes sense. You mentioned Bitcoin earlier. There is a lot of fear of missing out here too. I am not a big fan of Bitcoin. I don't think it's a Ponzi scheme too, or stuff like that. I'm kind of in the middle of the field, but it's clear that a lot of people, myself included, thought at least once, I should have bought it at $20,000 and now I've missed a lifetime opportunity and I have to catch up somehow. What is your point of view about it?
So given that is gaining share, again, this is the Keynesian beauty contest framework, right? Bitcoin falls into the same underlying component. It doesn't matter what Ricardo thinks, what Mike Green thinks. It's what the next person with $1 to spend thinks.
The greater fool's theory.
It's not even, you don't have to be a fool, right? You could ultimately believe that Bitcoin is the most beautiful girl. Well, I don't think that that's the case, and I have my reasons for that, which are going to far exceed the amount of available time we have. I just want to emphasize that, what you're trying to figure out is what the next person who's going to spend money on an investment thinks. Do they think that it's unattractive, or do they think it's attractive? In the case of Bitcoin, the underlying fundamental component, it is a Ponzi. It can only generate cash flows for future investors for the current investors by obtaining it from future investors. There is no embedded cash flow associated with the network itself. And so it is, by definition, Ponzi in its construction, and will ultimately end up going the route of all Ponzis. It will collapse upon its own weight. Whether that happens today or tomorrow depends on how many people think it's the most beautiful girl in the beauty contest. And there are still an awful lot of people that are apparently blind. And so that's, going to influence the interpretation of how the beauty contest is going to play out. Bitcoin is very unique in its framework because it's sold as effectively a millennial type framework. The world of fiat is coming to an end. Secure your life raft by pledging fealty to our new god, Bitcoin.
Yeah.
That's the pitch, right? And throughout history, Italians in particular have embraced various cults of these types and these types of beliefs and engaged in crusades, etc., to try to reclaim access to heaven. Maybe they are terrible investors. Maybe you were right at the start. But the simple reality is that that's the framework that you need to apply to these things. And candidly, the Bitcoiners and crypto investors are correct that traditional finance, under my framework of passive, is looking more and more identical. So if you separate it all from fundamentals, then what you actually end up with is the feeling that many of us now have, which is one of nihilism. Nothing really matters. And that, unfortunately, is percolating through our social fabric. It's percolating through our markets. It's percolating through our individual lives. More and more people are choosing not to have children. They're not having traditional family units. They're not behaving in the frameworks that we know are ultimately necessary for the survival of the species. And it all boils down to it's John Bogle's fault. That was a joke, but it's, the reality is much more serious, that when we engage in behaviors that contribute to nihilistic behaviors, we are ultimately damaging ourselves in the process.
Wow. Michael, we're running out of time. I know you have another appointment shortly. I can't thank you enough for being here today for this profound and insightful conversation that we had together.
Thank you very much, Riccardo. It was a pleasure speaking with you.
Bye-bye.
Bye.
And that's all, folks. I hope you enjoyed this episode and that it didn't stress you out too much. Maybe Mike is right, maybe in the end the others will be right, or maybe, most likely, the truth lies somewhere in between. We may see major vertical crashes in the future, but also explosive recoveries. What really matters is knowing that staying the course, diversifying and managing our portfolio's risk according to our financial planning and common sense will always be the best answer to all our doubts. With that being said, a heartfelt thank you to Michael Green for accepting my invitation and for the invaluable insights he shared with us. Before we wrap up, I encourage you, as always, to hit follow and turn on notifications on Spotify, Apple Podcasts, or wherever you listen. And if you found value in this episode, please leave a 5-star review to support us. It helps us keep bringing you guests who might seem like the bad guys at first, but are actually good, wise giants whose warnings make us all smarter investors. That's truly all for this episode, and I'll see you next Sunday for another deep dive, this time on what generative AI has to say about my portfolio. All of this, of course, right here on The Bull, your personal finance podcast.